Back time now for Options Corner. Taking a look at CoreWeave. It reports earnings after the bell. Joining us to take a deeper look at the chart, we've got Rick Ducat, lead market technician. All right, Rick, this has been a high flyer this year, but bumpy recently. What trends do you notice?
Yes, so this company has been moving to the upside here for most of the past year, but recently a bit of more of a downswing, but still handily outperforming not only the tech sector, but also the S&P 500 as well by a broad degree, up about 160% here. So if we were to look more specifically at CoreWeave, not too many companies are similar to this kind of a hyperscaler that rents computing power here, but some other companies are Nebius Group, NBIS, and this other company here, APLD. Those are similar companies. Those are up even more, showing the relative interest in this space here. But as we were to look at our candle chart here, trending downward since we hit those highs near 187 all the way back here, we can see that we connect these subsequent highs here to give us this channel type shape if we were to duplicate the trend line and put it across the bottom. For now, though, trending lower in a sharper, more swift downward sloping trend line here. Our low point near 105 after this surge to the upside here was met once again here and here. So that was a key area that we've started to drift through. That opens the door to these subsequent lows right here near about 85.26 is where they came in more specifically. If we were to look at the RSI study, our measure of momentum, a big breakdown here. We have broken through the 50 midline and our green trend line here as well. So momentum starting to worsen here, not really improving much, too terribly much on Friday despite our green day. Additionally, when we look at our volume profile study, we've given up several of these key areas here. Now we are within this larger volume node here. Our -1 standard deviation channel as well comes in just below 107 as of Friday's close. That could be a resistance point to consider going forward here. Not really too terribly much volume at all either until we get all the way down here, our -2 standard deviation channel near about 68.50.
All right, thank you, Rick. That's Rick Ducat, a lead market technician. Now to take us through an example trade, we've got Tom White, co-host of Fast Market and senior options contributor. All right, Tom, what's the approach you would take for an example trade for CoreWeave, given we've got earnings in front of us?
Yeah, Rick, his technical analysis kind of highlighted the pullback that we've seen. We're down over 40% from those all-time highs that we had in June for this name, and a lot of those concerns about the investments in AI. But the hyperscalers aren't pulling back on any of those investments. They've got 4 really big customers, so you got to take that into consideration. So if you think the stock's going to maybe rebound post-earnings, it's sold off over 20% just since the start of November. Stock's trading about $109 here in the pre-market, so it's up with the overall market. So I looked at a strategy that takes advantage of different vol levels between different option series where you can take a directional bias. This example is going to be bullish. If you're bullish on CoreWeave, the option market's pricing in about a plus or minus 13% move. Remember, last earnings, they fell about 16%. Post-earnings, so it does have that ability to move because of the thinness in trading here. So I looked at a bullish call diagonal here where I'm going to go out to the November 21st monthly options that expire in 11 days. We're going to buy the basically at the money 110 strike call. The stock opens up here about 109. Buy that 110 strike call, and then in the near term, November 14th weekly options that expire in just 4 days, and you're going to capture that earnings event tonight after the close. Sell the 122 strike call, so a bullish $12 wide call diagonal to the upside. You're going to pay roughly a debit of about $6 if we open up here at 109. There's your risk, $600, and it's half the width of this bullish call diagonal. And why is that? Well, because you're buying about 118, 115% implied volatility in the November 21st weekly option, selling about 140% in the near-term option. So that dispersion lowers the entry point price. On this strategy, you need the stock to go above about $112. That's going to be all profitability. And because you're paying less than half the width of the diagonal, anything above that level is going to be profit on this one. And you can flip this strategy. If you're more bearish, buy a put diagonal. It's about the strategy. You pick the direction.
All right, you pick the direction. That's the word there for Tom White, co-host of Fast Market, senior options contributor. Thank you, Tom.